Hi, Scott. How are you doing today?
Lynn, I'm doing great. Good to be with you today.
Well, thanks for joining us. Today, my guest is Scott Saunders. He is Senior Vice President with Asset Preservation, known as API, which is a subsidiary of Stewart Information Systems Corporation. And Scott is like the expert, I think, in the country, from what I'm reading, on 1031 exchanges. And he's been doing it for 32 years. You look pretty good for 32 years in the business.
Thank you. The business has been good to me.
We're going to be talking about 1031s, which is a really interesting topic. And I also would like to note that the date we're recording this is October 27th, 2020, excuse me. And the reason I say that is because things change. So we're talking about the industry as it sits today, correct?
Absolutely, absolutely. And I'll give a disclaimer. I may say it later on as we're talking, but in any 1031 exchange, you always want to get your tax and legal advisors involved, right? Because you've got your individual tax situation, your unique facts and circumstances. So as a qualified intermediary, I can talk about the rules and the process, but it's always recommended that a business owner or a real estate investor talk with your CPA or your tax advisor, review your specific situation. Because everybody's got a little bit of a different situation, and we'll just be talking about general principles here today.
Okay, good. You're frozen. Are you okay? I think you're frozen. There you go. All right.
All right.
So let's start. Let's get going here. What
good.
is a 1031 exchange?
Great question. A 1031 exchange is a provision in the tax code that allows anybody that holds a property for investment purposes or for use in a trade or business to exchange that for another like-kind property. And when you exchange it, you're able to defer paying the capital gain taxes and all of the different taxes that would otherwise be associated with the sale. So it's a very powerful strategy for business owners, for real estate investors, large and small, to allow them to redeploy their capital into better performing properties.
Great. So why would an investor or business owner want to do a 1031 exchange?
Someone want to do an exchange if they want to purchase more real estate in some way. So a business owner that maybe wants to expand their business, they want to go from an older location, maybe upgrade, go to somewhere where the part of growth is taking place, maybe increase the size of their business, more frontage space, something like that. For a real estate investor, it would be anybody who wants to get a better return on investment. So maybe you've got one single family rental with a lot of equity tied up in it, but that money could be redeployed with some leverage and get a better rate of return, right? Get a better cash on cash return. So we'll see a lot of small investors maybe exchange out of one single family rental, and they'll pick up three, and they'll get maybe a lot more cash flow, 2 to 3 times more cash flow and more tax benefits. So at the end of the day, it's because you maybe want to pick up a larger property, maybe want to diversify, maybe you want to relocate your business, right? You're selling a business and you're going to relocate to another area. You can do that with a 1031 exchange and push back or postpone paying those capital gain taxes.
Great. So what are the benefits of doing a 1031 exchange?
The benefits, the biggest one would be tax deferral, right? Instead of taking your money and paying taxes now in a taxable sale, you get to take all of those proceeds, what I call the gross equity, right? Or the net equity after the closing costs, and you can reinvest that. If somebody had to pay taxes, depending on, and taxes vary depending upon what state you're in, but there are 4 different levels of taxes. So somebody would pay depreciation recapture at a rate of 25%. Then the remaining economic gain at the federal level is taxed at 15 or 20, depending upon taxable income. There's something called the net investment income tax. So there's an additional tax of 3.8% for single filers over 200,000 of income, or 250 for married filing jointly. And then finally, you've got state taxes. So some states have very high taxes. The highest one right now is 13.3% in California. So if you take all 4 taxes and add them up, you're going to be writing a big check, and that's money you can't use to redeploy into another property.
Mhm.
So what you get with an exchange is really all of that additional purchasing power available to you to reinvest into, larger properties or multiple properties.
Great, great. How long have exchanges been in the tax code?
A really long time. Right now, today, we're sitting here, October of 2020, and they've been in the codes for 99 years. So actually, next year will be a whole century in the tax code. And the reason why that's important for people to know, it's not some really ultra aggressive strategy where you need to be concerned. It's something that's been there for a long time. We've got a lot of very clear-cut rules on how to do them. And what's interesting is, during that time, we've been through, good economic conditions, bad economic conditions. We've been through various administrations, on both sides. And at the end of the day, it's such a powerful tool to help people redeploy their capital into better performing properties or into expanding their businesses, that it's been around for that long. So, it's been around for a lot longer than the home mortgage write-off, for example.
Good. Okay. So what are the requirements for a full tax deferral?
If somebody wants to not pay any taxes in this year, if they want to defer taxes, there are two things they need to do. Number one is to reinvest what we call the net equity. So that would be after the real estate commissions and closing costs. It would be that net amount on the settlement statement. So that's rule number one. The other rule is not quite as obvious, as you need to have the same or a greater amount of debt. So for example, if I sell a property and I have $100,000 of mortgage, then I would need to have at least $100,000 of mortgage on whatever I'm going to buy. So number one, reinvest in net equity. Number two, have the same or more debt. There's one little caveat, which is you can go down in debt, your mortgage amount, if you bring in outside cash to offset it. So let's say I had a $100,000 mortgage and I only want to have 80. If I bring in 20,000 of outside cash, I can offset that debt amount. So that's what you need to do for full deferral. A lot of people, about 1/3 of all investors, receive some of what we call boot, that is taxable. So 1/3 of the people get a little cash out, or maybe they go down in their mortgage liability and pay taxes on that. So some people, about 1/3, pay some taxes and do what we call a partially deferred exchange.
Okay, that's interesting. So the boot was what again? It was explain that.
Boot. Yeah, it's a weird term in the 1031 world. So the simple definition of boot is just non-like kind property. So that would be cash boot is cash that you receive. Mortgage boot is a reduction in your mortgage liabilities. And sometimes that's called debt relief. So boot's cash, you get money out, or you don't have as much mortgage on one or more replacement properties. That's called mortgage boot.
Okay, new term for me. Okay. What is a like kind property?
That's a great question. And so many people confuse this a little bit. There's always a little bit of misunderstanding. Like kind property is simply any real property, so real estate, held for productive use in a trade or business, or held for investment. So it's really broad. It's any investment property. It could be bare land for a single family. It could be a single family for a commercial property or industrial. It could be, in some cases, a vacation home that is considered held for investment that can qualify. So like-kind property is very, very broad. And by the way, business owners can exchange a business property for another business. An investor can go from an investment property to another investment, or you can even cross over. I could have an investment property and I could exchange for a property I'm going to use as a business owner in my business. Or maybe I'm a business owner, I'm going to sell my business. I could exchange that for an apartment building, maybe for long-term investment in my retirement income. So very, very broad. And I won't go into all the different nuances, but things like there's certain oil, gas, and mineral rights that can qualify, water rights in some states, air rights, agriculturally conservation easements. I mean, like kind is very, very, very broad, but it has to be real estate. So personal property doesn't qualify. It's got to be real estate or real, what we call real property.
Okay. So I was going to ask you what property cannot be exchanged. I think you touched on a little bit. Personal
Yeah,
property.
yeah, there are probably three categories. One would be personal property you can't exchange. That was a change in the tax code that came about with tax reform a few years ago. So the Tax Cuts and Jobs Act eliminated personal property exchanges. Prior to that, people did exchanges on aircraft and artwork and rental cars and equipment and combines and tractors. And as part of tax reform, they agreed in Congress to meet some different budget reconciliation rules. They said, okay, we're going to get rid of personal property exchanges, but leave it for real estate. When we look at real property, there are really just two types of property that don't qualify. One's pretty obvious. The house you live in doesn't qualify. So if you live in it and it's your residence, there's another provision in the tax code called Section 121 that deals with the house that you live in for 2 out of 5 years. So that's the one type. The other type is any property that is held for sale purposes rather than long-term investment. So examples of that would be maybe a developer. They put up a project and they're going to sell it off. They can't do an exchange on that because their intent is to hold it for sale. They might make money on that, but it's not being held for long-term investment or rental income. And
Okay.
another category that comes up with real estate would be properties like what we call a fix and flip. Somebody gets a property at a low price, they spruce it up, and then they immediately want to sell it for that short-term profit. You can't do an exchange on a fix and flip. So to summarize, primary residence doesn't work, and then any property where the intent is to hold for sale versus long-term investment.
So could you buy a house? I'm going to ask, this is going to be a weird question. I buy a house, I live in it, then I go rent it, and then I sell it. Then is it 1031 exchange?
Great question. Potentially. It depends on how long you rent it. So yes, you can live in a house, move out of it, now make it a rental. And as long as it's been rented, we could talk about how long, but for a reasonable period of time, it's now an investment property. Now you can exchange it for another investment property, but you couldn't exchange it for a house that you're going to live in. And there are a whole lot of other nuances. You know, since you opened up that question, Lynn, I'll kind of piggyback on with some more, but there are what we call split treatment transactions. What if I have a house that I live in, but maybe I've got a mother-in-law unit on a detached garage, or maybe I've got a walkout basement that I rent out to tenants. So now I've got one piece of real estate, but I live in part of it and then I rent out part. You can actually do an exchange on the business portion or the rental portion. And so I met a business, you know, somebody that maybe has a shop or a barn where they operate their business, even though they live in the house right next to it, that part can qualify for a 1031 exchange. So there are all sorts of different ways you can kind of bounce between a property that's you live in versus rental, and you can kind of go back and forth on it. You could even do an exchange for a rental, and maybe you rent it out for a few years, and then later on decide you want to move into it and make it your residence. So all sorts of planning opportunities out there.
All right. So what are the most popular exchange formats?
The most common is what's known as a delayed exchange. Sometimes it's referred to as a deferred. So if you were to look at the ways that you can changes, you can do a simultaneous. So you and I, Lynn, would have houses and we could swap our houses. They're both rentals. That works. Very rare that happens because you and I have to want each other's properties and everything has to line up. So that's one format. The delayed exchange is probably 97% of all exchanges are delayed. And we'll talk about some of those time requirements. And then there are a few other variations that are known as parking arrangements, where an entity that's owned by the qualified intermediary is actually parked on title. So those are called reverse exchanges, improvement exchanges, or reverse improvement exchanges. Much, much more complex. So they're a great tool, but they're quite a bit more complex and expensive, and they've got a lot more moving parts with them.
Wow, okay, let's see here. what are the time deadlines in a delayed exchange?
The time deadlines are pretty straightforward. When somebody does a delayed exchange, they're going to sell their property to a buyer, and before closing on the sale, they contact a qualified intermediary. We then are assigned into their purchase and sale agreement. So there's an assignment of the right to sell the property. We sell the property to the buyer, and then the qualified intermediary receives the money. So they're actually the seller of the property. When that property closes, that's day zero. And you've got two time deadlines. You've got 45 calendar days to identify property that you want to buy. So it ends at midnight of the 45th day. We call that the identification period. Then you have an additional 135 days after that, so a maximum of 180 days to close on property that you've identified. So day zero, 45 days to then identify property, and then another 135 days to close on what you've identified.
Now, has that timeline changed with COVID?
Great question. There was a little extension provided by the IRS. There was a little extension that applied for just a few months.
Oh, okay.
That expired on July 15th. So there's no more extension. Right when COVID was, when everything was kind of going crazy and we didn't know what was going on in March and April and May, there was so much uncertainty. We all went through that. So the IRS gave people a break, but it was really pushing it back just till July 15th. There's nothing now that's in the code to provide any additional leeway.
Okay. I'd heard about it. I heard about it. My mom had sold a property during that time and we were trying to talk about it, but real estate agents weren't even allowed to work during most of that time, at least in Michigan. Okay, what are the identification requirements in a delayed exchange?
When you identify, there are a few things. There are what we call 3 different identification rules. So the first and probably the most common is what's known as the 3 property rule. So somebody sells, they can identify up to 3 properties of any fair market value, but you're limited to 3. The other way of identifying is what's known as the 200% rule. Under the 200% rule, you can identify as many properties as you want, but your value cannot be more than 200% of what you sell. So let's say you sell for 400,000, you could identify a lot of smaller properties, but the total value can't go over 800,000. So when you look at those rules, the first one is kind of unlimited value, but you're limited to 3 properties. The second rule is an unlimited number of properties, but then your value is capped at twice of what you sell. Now there's one last rule that's rarely used, which is known as the 95% rule. And simply put, it just says you identify more than 3 properties and more than 200% of what you sold, then you must actually close on 95% of what you've identified. So if you think about it, let me put it in simple terms. I identify 10 properties, each at 200,000, but I only buy 9 of them. Well, that was just 90%. I then would have to pay my capital gain taxes. So very rarely is that used. And a couple little caveats, Lynn, to toss in here. If you close on a property within 45 days, that's considered identified. So if I actually buy it and close on it, that's an identified property. And then the last thing to keep in mind is you've got flexibility in that 45-day period. If I identify A, B, and C on day 5, but then I'm working with my real estate professional, I find much better property on day 42, I can unidentify A, B, and C, and I can substitute D, E, and F under the 3 property rule. So anywhere within 45 days, I can do that. The trick with the 1031 exchange, though, is you can't do anything after midnight of that 45th day. So if
I was going to ask that. Yeah.
Yeah, that's the one where people get frustrated. They go, well, what if I'm doing due diligence and I do a home inspection and I find problems? What can I do? Or what if the property gets sold out and somebody else buys it? There's no flexibility. You've got 45 days. And when I say calendar days, they're going to go through weekends. They're going to go through holidays. So they're just sequential days. They're not just weekdays, but they're just days on a calendar. So a practical tip, that I'll share with your audience is when you get your what we call relinquished property, that's the property you're selling. When you get that property under contract, start looking for your replacement property then, because you don't need to wait until it closes to start working with your real estate professional. Do that, earlier, and you can start firming it up. You can look at properties you like, start making offers, doing things like that, and it takes out a little bit of the stress. The stress in a 1031 is where somebody doesn't do a lot after they close, and they're sitting there on day 43 going, I've got 2 days. And if you don't identify, then you have to pay your capital gain taxes.
Right, you lose the whole thing. Okay, so how long does
Exactly.
it take to get an exchange set up?
Exchange can be put in place fairly quickly. A company like ours is called a qualified intermediary. Sometimes you'll hear us referred to as a QI, an intermediary, an accommodator. They're all kind of synonymous terms, but you call it a qualified intermediary, and what they're going to need will be a copy of the purchase and sale agreement, so the real estate contract.
Mhm.
They will work with the closer and get a copy of the title commitment, so just making sure that they know the vesting and the property address. Look at the contact information for that business owner or real estate investor, and then the contact information for the closing officer, and prepare all of the exchange documents. That can happen in an hour if needed. It doesn't take a lot. The key thing I think it's really important for your audience is you've got to get the exchange set up prior to closing. You can't close a transaction and then after the fact go, oops, I didn't do it. I want to go back and set up an exchange, because then you actually have what we call control over the money, or actual or constructive receipt of the funds. So
Mhm.
some people set up an exchange at the last minute and go, I don't know if I need to do this or not. Let me find out what my tax consequences are going to be. And a lot of people will set them up and see if they can find a property that they like. And sometimes they succeed and sometimes they don't. But you lose the ability to defer taxes if you actually sell the property and receive the money.
Okay. What should an investor or business owner look for when selecting a qualified intermediary? Like,
Well,
such as your organization, right?
they should look for, yeah. There are a lot of excellent companies out there. Let me share something with you that I think is important for people to understand. So we qualified intermediary. We've been doing this for, I told you, 99 years now. Um, Certainly, a lot of commercial transactions go through exchanges, and then a lot of investment properties do. It's millions and millions of transactions. We, as an industry, are not regulated anywhere at the federal level, meaning we're holding
Wow.
significant sums of money, right? Hundreds of millions, billions of dollars, and yet we're not regulated at the federal level. Now, there are state level regulations. So a few states, and I might miss one, but Colorado, Nevada, California, Oregon, Washington, Idaho, Connecticut, and Virginia have state level consumer protection laws for their state. So, that's 7 or 8 states, so a handful of states that have that. But even that is not very stringent. It definitely provides an additional layer of protection. So, back to your question, what do you want to look for? I would say you really want to find out, how is that money held and how is it being secured, right? You don't necessarily want to be a huge depositor in a little local community bank. That might be a little risky, but there are qualified intermediaries that are subsidiaries of bigger parent companies. So some banks have a qualified intermediary subsidiary. Most of the major title insurance companies do. So our parent you mentioned was Stewart Title. The other title companies, the other major ones, have subsidiaries. So certainly being a subsidiary of a larger parent company provides a little extra protection, because now you've got all of those institutional type controls and checks and
Right.
balances. So I would say find out the money, how is it secured? And another one that's really key is make sure your money goes into what is called a segregated account. You don't want your money commingled with everybody else. So unfortunately, there have been some big bankruptcies in our industry,
Mm.
significant sums. There was one in Las Vegas for 100 million. There was
Uh,
a company that bought different companies around the country, and it was a $132 million bankruptcy. And the biggest one was a $420 million bankruptcy, where they invested in what are called auction rate securities that went illiquid. So the point would be, find out who you're going to be giving your money to. They actually
Yeah.
control it that short period of time. There are great companies out there that have great security mechanisms, but I think that's what you want to look at. You can certainly look at their fidelity bond coverage. How much do they have? How much experience do they have doing this? Those are some other things to look at as well.
Great. So we're running out of time here. So I got one last question, and then I'm going to ask that you share how the audience should get a hold of you. So can you share with us what a commercial agent would need to know if one of their clients wanted to do a 1031 exchange?
Yeah, the key thing to know in regards to being a commercial real estate professional is setting up the exchange well in advance and then reviewing it with their tax and legal advisors. Particularly in a commercial transaction, the way people hold title investing, you have partnerships and LLCs a lot of times on commercial transactions. That makes things a little more complicated. What if some of the people want to exchange and others want to just sell? We can't do an exchange on a partnership interest. It's prohibited under the tax code. So there are some strategies, there's some ways we can work around that. But I think as a real estate professional, you want to get your customer talking to their tax advisor early on, bring in the qualified intermediary. We've done hundreds of thousands of exchanges. So we have a lot of experience doing this, but we can't technically provide the tax advice or the legal advice. So bring us in, maybe identify some pitfalls and kind of look at what's going on. If somebody's going to sell to a related entity or buy from a related party, that can be an issue. There are a lot of issues on commercial transactions. And the other one is there are opportunities too. Somebody sells a commercial building with a cell tower on it. You could do an exchange on the cell tower, but sell the building or vice versa. So, I mean, there's some pretty interesting things that you can do in the commercial space related to exchanges that are very creative. If you've got a business owner that maybe wants to relocate, there are ways that we can build a new plant in the 1031 exchange, right? We can do what's called an improvement exchange, build a brand new facility that's bigger, all with tax deferred dollars. So lots and lots of planning opportunities in the commercial space for sure.
Wow, that was really great. I got to tell you, you're the first I've never heard anybody talk about it so well before. So I wanted to, so for our audience, if they would like to hire you, which I would definitely recommend. By the way, everybody, I want to tell you that Scott is like one of the experts across the country. So you've got the best guy here there is. Can you tell us if they'd like to hire you, how they would go about doing it?
Sure, be happy to do that. So the company I work with is Asset Preservation. Website is apiexchange.com. Toll-free number is 800-282-1031. And my email is pretty easy, right? I know 1031 makes it easy to remember. My email is just my name, Scott, at apiexchange.com. So we got a great website with a ton of information. And I will tell you, feel free to reach out. I've got hundreds of articles that I've written. A lot of times you might have a scenario where I could just send over to you an article that talks about your exact scenario or the things that you're facing. So, I would say as a business owner or as an investor, use a qualified intermediary as a resource. We can help you out. We've done this so many times that we probably know how to navigate some of the pitfalls that maybe you haven't faced. And we do that in conjunction. So you as a real estate professional know the market. We know the space of 1031s. Your tax advisor knows your tax situation. Bring all those together. And especially if you do it well in advance, the thing where I'd say people get into trouble is they midstream, they do some of this, right? They're partway through an exchange and they haven't looked at some vesting issues or they haven't looked at some financing issues. And now all of a sudden, they've got some requirements to adhere to for the exchange, but then they've got business considerations. And some of those times those things conflict. If we do this well in advance, we can a lot of times set it up so it'll be a smooth transaction and all those pieces will pull together. So that's just something to keep in mind.
All right. Well, thank you so much, Scott. I really appreciate your time.
Oh, it's been a good time. Nice chatting with you. Hopefully I shared a nugget or two that'll be of value for your audience, Lynn, and, provided some information that's of value add. And if you want to follow up sometime later on, You know how to find me. Be happy to do a follow-up if you find that it's warranted down the road.
All right, thank you.
All right, thanks a lot.